Hello and welcome back to the Market Lens. I'm Sam Rozzi, Manager of Due Diligence, and I'm joined by Cliff Walsh, our Chief Investment Officer. Please check out our previous episodes in Studio 454 or on YouTube. Today's News or Noise segment will highlight the potential minimum corporate tax. Mega cap corporations, and more specifically big tech, have been under extreme scrutiny for some time now, as they frequently are using the tax laws to minimize their taxable burden. One of the most commonly referenced examples is that Amazon paid an effective tax rate of 9.4% in 2020, less than half of the corporate tax of 21%. Is this proposed minimum corporate tax news or noise?
I think it's news. There's still a lot to learn about it, and even for the G7 players to flush out. Canada, France, Germany, Italy, Japan, the UK, and the US have announced a plan to impose a minimum tax on multinational corporations and rewrite the rules governing how countries tax them. There's no detailed plan, and as you know, the devil is always in the details, but here's what we know. G7 finance ministers agreed to pursue a global minimum tax rate of at least 15%, and to allow market countries to tax up to 20% of the excess profits above a 10% margin of around 100 large high-profit companies. The G7 deal likely would mean that higher overall tax bills for many of the bigger tech companies, with more of the payments potentially going to countries in Europe and less to the US. Counteracting this somewhat would be the removal of digital services taxes that have been applied to big tech companies in the past couple of years in several European countries. The G7 deal could expand to include the larger G20 group of nations, followed by the OECD, a group of mainly wealthy nations that has led tax negotiations for quite some time, so potentially pretty significant. Given that the top 5 stocks make up roughly 20% of the S&P 500, it's definitely news. Just looking at Apple, with 65% of its business overseas and with high margins, it could knock 30 cents from earnings at a current multiple of about 23 times. You're talking more than 5%. That's market moving. As the details come in and lobbyists weigh in, we'll see what happens. The UK is already pushing for financial service firms to be exempt, and right now this deal wouldn't include Amazon, as you mentioned, because they don't earn that 10% margin overall. However, we could see a push for business segmentation to tax profitable parts of the business individually, meaning Amazon's web services will be taxed regardless of whether or not retail sales turns a profit. This would make it more difficult for companies to avoid the tax. Without segmentation, I would expect businesses to rejigger their operations to offset profits against loss-making units to remain under that 10% threshold. So still, a lot has to be done, but it's definitely worth keeping an eye on, and it's going to take some time. This could potentially require an international treaty to get it done, which would mean a 2/3 majority in the Senate. My sense is that Republicans aren't too keen on dinging businesses heading into the 2022 elections, so if the G7 can't get around that, it might flop, but the risk is there, and it's meaningful.
Thank you, Cliff. I agree that this is news and could certainly shake up broader equity markets if it gains steam. My favorite stat to chat with advisors about is the largest 10 companies in the S&P 500 make up 31% of the overall earnings. If these giants face headwinds, I believe it could affect their stock prices. Now, let's zoom into the market lens, where we will again focus on inflation. Inflation continues to make headlines, as May CPI was up 5% compared to the past year. Everywhere I seem to turn, I hear people discussing inflation, and the consensus from talking heads seems to be that it's here to stay. You've previously said that you're not too concerned about inflation in the long term. Can you dive into your thoughts on inflation?
Sure. Many investors are looking at the government stimulus, the big budget, the infrastructure package as drivers of potentially runaway inflation, but none of those are the real drivers of the numbers we've been seeing on the inflationary front. The pop in inflation is coming from the combination of the economic shutdown, inventory reductions, out of whack pricing comparisons, and temporary supply-demand imbalances as we reopen. Let's play a little game. I'm going to pull out huge outliers driving up the CPI, and you tell me where you think prices will be, up or down, in 6 months. We'll revisit them at the end of that time. No pressure, won't impact your bonus. Sound good?
Okay, let's do this.
Okay. Gasoline up 56% in the past 12 months.
Up. I think the reopening will continue to gain some steam here, and it will drive further demand for gas. I think most of the upside has already been had. If I'm wrong, prices continue up another 50%, you might find me at the nearest Tesla dealership.
Used cars and trucks, up 30%.
Down. I think the various COVID issues were one-time events, and we'll see normalization now.
This is a result of the computer chip shortage limiting new car production. There's a Ford truck manufacturing plant in Kentucky with 20,000 trucks waiting for chips. This is happening all over the country. It'll work itself out in the coming months. Even if prices don't decline, I can't imagine we'll see another 30% uptick driving CPI higher. Airline fares up 24%.
Up. While people are starting to fly, we're nowhere near our peaks. These major airlines are going to want to recoup some lost profits, and I think the easiest way will be continued price increases, especially if we're truly in for a new roaring 20s.
You can definitely argue up because we're not back to where we were prior to the pandemic, but again, I can't imagine they'll be up another 25%. Who was traveling in May of 2020? The comparisons are just silly. Car insurance up 17% year over year.
Down. I think this is due to COVID, and this will snap back.
Yeah, I'd argue this is a result of the 15 to 20% reductions many insurance companies gave during the pandemic that have now returned to full pricing. That's obviously not going to continue. Car and truck rental up 110%.
Down. These numbers don't seem sustainable to me.
Yeah, obviously the horrible comparisons again, as no one was traveling a year ago, not to mention inventory is tight and new car production is creating shortages in the supplies for new fleet. Once chip production picks up and we get past the poor comparisons, this is not going to drive CPI higher. Here's a good one. Bacon up 13%. That's just a national travesty. You don't even have to speculate on this one. I just needed to complain about it.
Yeah, this is just upsetting.
Major appliances up 12%, laundry equipment up 26%, men's pants and shorts up 12%, jewelry up 13%, moving expenses up 16%. I think you get the point here. We're seeing reopening demand with supply yet to catch up and comparing them against once-in-a-lifetime economic shutdown. It's not going to last. Supply is catching up, demand has been pulled forward for many household goods, and we're about to move beyond the horrible comparisons. We're just filling gaps here. And I didn't cherry pick this data that I had good explanations for. I chose those with the highest price increases, and I think I made a pretty good case, and you did as well, that the trends won't continue and potentially some of these areas could provide deflationary pressure on the CPI in 6 months to a year. From an investment standpoint, I would be fading inflation here, considering how much bad news is factored into for bonds, massive inflation chatter, huge increases in commodity prices, record money supply growth, double-digit GDP growth, infrastructure stimulus, wage increases. Yet look at the 10-year Treasury action on the 5% CPI print last week. I was actually down a few basis points and significantly below the peak of its trading range. We could have very easily 12-month peak in inflation. As the stimulus check impact fades and spending shifts to services, I would expect demand for goods to slip just as supply catches up. I think we'll be talking about many, if not almost all of the prices we discussed pulling back, some sharply by the end of the year, and we'll have a consumer goods demand problem, not a price problem.
Thank you, Cliff. I think you made a very compelling argument here. While that wraps up today's segment, I hope in the future we can go into more detail on what areas of equity and fixed income markets may stand to benefit if we're right. Thank you everyone who joined us, and I hope this is letting you see 2020. See you next time.